Ladies and gentlemen, I just want to get straight into this. What I'm talking about here, the end of ESG as we know it, and I'm sure a lot of you are curious as to exactly what we're talking about here. It's actually a contradiction in terms. The reason that we've come out with this is because we think we're at a huge inflection point in the markets at the moment. And it's really, really focused on ESG. So much so that we believe that the forces that you're seeing, the investment forces, the focuses on, ESG in general, are going to become so mainstream that ESG stocks, ESG investing as a principle is going to become so mainstream that it will replace traditional investing. Now, that's not to say that, there are companies that are going to go to the wall because of this. It's just that ESG will become so important to so many companies that fund managers of traditional funds will start to find themselves owning ESG companies, not because of their ESG credentials, just because of their normal investment process. It just so happens that the majority of companies, investable companies on the stock exchange, are going to be showing very, very good ESG credentials. So we believe that ESG as a standalone asset class is on the decline, predominantly because of its incline, because of its acceleration into mainstream markets. We believe they're going to come synonymous. I hope that makes sense. It's a very simple concept that we're talking about here, but it's one that we believe is yet to be given the limelight and the attention that we think it deserves, despite the fact that it's been such a massive asset class over the last few years. I put here, ESG will be the biggest disruptor in our lifetime. We're past simply not owning animal testing and fossil fuels. It's a bit of a basic comment, but I hope you all appreciate that, ethical investing of yesteryear was very much clients saying, well, I don't particularly want animal testing, or I don't want to invest in oil, but, as long as I don't have that in my portfolio, I'm okay. And a lot of fund managers adopted that approach as well, which was a negative screening, just to say, I'm going to screen out tobacco, oil, mining, and then own the rest. And I just think ESG is so far advanced from that. We are in a completely different ball game now. And that's why it's going to be the biggest disruptor of our lifetime. It's because it's going to ingrain itself into every facet of life. I think every single company, every single sector in the investment market and in the, we talk about Wall Street versus Main Street, even in our day-to-day lives, we're going to start to see this coming through, these ESG, these ethical components. I put here the UN Sustainable Development Goals as a kind of as a yardstick of where we are now. That's 17 goals outlined by the UN in 2015. Which looks to basically, I don't want to say save the planet, but it looks to address some of the shortfalls of our planet and of us as a society, and where we want to go and what we need to achieve in order to get this world, in order to get the global economy in a good state of affairs, in good shape, if you will. They're coming out with $5 trillion a year that needs to be spent on these sustainable development goals to get us where we need to be. That's what we as a global community need to spend on ESG just to get us where we need to be. That's huge. So again, just trying to push the point that we're so far advanced from where ESG kind of originated, ethical investing originated. Why are we talking about this now? Well, it's not going to be lost on anyone that COVID is, we're in the throes of COVID. The entire global economy has been put into an induced coma, essentially, to get, to fight the COVID virus. And whilst the viral numbers are coming down, thankfully, thank God, infection rates and death rates are seemingly on the decline. The economy is going to be left with the hangover and the consequences of what we've been doing, and the measures that we've had to take to stave off this virus taking hold of the world. So what I'm trying to say is COVID, in terms of ESG, I think it's going to be a massive inflection point. For a few simple points, which I'm going to try and outline now. So if I just break down E, S, and G, right? So I think each one of those ESG, so that's environmental, social, and governance, to do with ESG is, every single one of those has an inflection point to do with COVID. If you look at environmental, we're in a global pandemic. This is a global viral induced pandemic which is affecting every single person on this planet. And hold on 2 secs. And what we can see is that, if anything, this is a huge realization for the global economy about what needs to be done to this planet to get it onto a stable footing. All you need to do is look at the pollution levels from COVID. They've been a massive benefactor. China pollution down some 70%. India pollution down some 70%. Indians in the north, in the northern regions of India can now see the Himalayas for the first time in 30 years. Citizens of Venice can now see the bottom of their canals. It, if anything, has shown us, when we pause what we're doing as a global community and look at how the environment bounces back, that shows us the damage that we're doing. So COVID has given a rare point for us to pause what we do from day-to-day life and actually see how, see what this planet should be looking like. That's a huge call to arms for ethical investing. The social element, I think, is a very interesting one of ESG. When it comes to COVID, you've got this huge phenomenon, and I'm bringing back to what we've got on the slide here, which is this stakeholder versus shareholder interaction debate that seems to be going round, and it's very much centered around dividends. So, the stakeholders in this world are the employees, people in the day-to-day lives, the day-to-day running of the businesses that are so important. You've seen governments coming out with trillions of dollars to help protect these people, to help protect the drivers of the businesses, to stop the whole world going into shutdown, economic shutdown. You've then got shareholders. Shareholders have very much been in the driving seat of what motivates companies and their behavior in terms of corporate behavior. Just looking on the left of that slide, you can see some of the dividends that are now up for discussion. You can see some of these major companies that have share prices that are largely or to an extent bolstered by investors that want that income, that want that dividend. That dividend is now being called into question. Indeed, you've got governments all over the world saying, if you want fiscal support from us, if you want monetary support from the government, you need to stop doing share buybacks and you need to start behaving more responsibly. So you've got a political pressure on the social element to do with companies. What the focus is now is, looking after your employees. What is their mental health like? What is their at-work from home policies like? Can you give them more flexibility? What are the furlough schemes like? There's a huge focus on that stakeholder versus shareholder. I think you're going to start to see that coming through even more in the attitudes of corporates. So you're going to start to see, these corporates not only not paying their dividends, but coming under fire for what they're doing with those dividends, what they're doing with that saved cash. I saw the Adidas CEO this morning coming under fire because, 2 days before the world went into lockdown, Adidas was doing share buybacks, and then they immediately went and applied for state aid. They shouldn't have been doing the buybacks, the share buybacks with that capital, and then apply for government help. It just goes to show the type of pressure that CEOs are under to be more fiscally responsible because of COVID. All of this feeds into ESG. And then you've got the governance issue, which again goes back to dividend pressure, which is going back to how these companies are going to behave with these dividends. Once these dividends have been called into question, what are they going to do with that capital? That capital is going to go back to work in their companies. If you've got a massive super focus on ESG, those companies are going to be motivated to put that money back to work in a more ESG-minded fashion, whether that's balance sheets, whether that's stakeholder interaction, whether that's supplier interaction, making their supply chains more ethical, you name it. There's going to be a massive focus from companies on making sure that their credentials are more ESG watertight. Now you can see here, I've listed out Brent crude on the right. That's one industry that the ESG market has been shunning for a very long time. If anything, one of the COVID crises has caused this has caused the oil market to crash. The ESG market has been calling for this for a long time. Again, another inflection point coming from COVID. We think it's very interesting what's happening. So what I also want to talk about is a second driver that's coming from COVID that I think is going to benefit ESG. And that's, I mean, I've listed them out here, and I'll talk about them, but essentially it's populism. Populism, I think, in the global economy, as we know, has been on the rise. It's been on the rise, arguably, you may disagree with me, but I think since 2008, since the global financial crisis, we haven't really truly recovered. Growth has been very slow. Corporates have been very slow. It's been called the most hated bull market in history. And I think consumers have really felt that. They felt that in low wage inflation, low income. A lot of the money that was pumped in to save the economy just went into capital markets in the form of QE. The guys on the street, the guys and girls on the street never saw that money coming through. And you could see that in the populism, right? You could see that in the election of Trump, in the election of Boris, arguably. Political figures like Bernie, political figures like Nigel Farage. You then had Brexit. You then had Trump being elected. All of these are massive populism factors. You've got the five-star movement in Italy. You've got immigration from Syria, from the fallout there. All of these things are big political shifts and big populism movements. Right? You've got that income inequality from the last crash. Now, what I want to do is link that to where we are today. If you take COVID and what's happened, you've got some 5 million people a week in the US becoming unemployed. Same in the UK. You've got company bankruptcies. You've got people being laid off. You've got companies saying that they weren't able to furlough some of their staff. They had to fire them. They had to make them redundant. The government in the UK announced that they would have a scheme for protecting furloughed staff. But for the first 2 or 3 or 4 weeks, the companies themselves weren't given any financial support from the government. So they had to pay those furloughed staff out of their own pocket. So these companies were running out of cash. So what I'm trying to spell is that you have this income inequality, this wealth divide from the last financial crisis. You've now got some 20% of economies becoming unemployed, and they need to get back to work. And from what I'm reading, the recovery of this economy, of the global economy, is going to be slower than everybody thinks. It's going to take a long time for people to get back to work. So, arguably, you can see this income inequality, this wealth divide, exacerbated because of COVID, because of what's been happening. So I think the populism trade is going to get even more. It's going to get even larger, and I think that's going to be focused around companies. It's going to be focused around ESG. It's going to be looking at what companies are doing, not only for their stakeholders rather than shareholders, but how responsible they're being with that allocation of capital. And that brings me on to my final point in the drivers, which is populism doesn't have to be bad. A heavier focus on less dividends to shareholders and more responsible allocation of capital, more fiscal responsibility, is a really good thing. And if populism forces companies to reevaluate what they value, their metrics, that's a good thing. What I also want to talk about here is that, arguably, and a lot of people might disagree with me here, but I think maybe we need to look at the metrics of decision makers in capital markets. At the moment, I think the old guard, I think some of the older, more experienced managers and investment allocators and decision makers in the world are still, are maybe potentially reaching the end of their career and looking to hand over to the next generation of fund managers, asset allocators, and decision makers. And that's going to be the younger generation. That's going to be the generation that were brought up on these income divides, these wealth divides, this populism. And I think their focus is going to be very much more on ESG responsibility. It's going to be, fiscal responsibility. The companies that we're investing in, how are they behaving? What are they doing to give back to the planet? What are they doing to help repair the damage from COVID? Less focus on dividends, more focus on stakeholder interaction. So you're going to have this wealth of decision makers coming through that reevaluate what the right thing to own in the market is. So again, populism doesn't have to be bad, and I think we're riding a tide of change here at the moment. So this is why we think it's a really important time for us to talk about not only is ESG going to be a huge disruptor in our lives, but I think COVID is actually the inflection point. COVID is the catalyst, potentially, to get us moving there even quicker, which is quite a phenomenal statement to make, considering how much focus has been given to ESG over the last 2, 3, 4 years. It's really started to become its own. So what I want to do now is I hope I've listed out to you, initially what we're saying and why we think the time for ESG to really accelerate is now, what the catalysts for changes are. I kind of want to try and link in the buy case, because at the end of the day, we are investors, we are stewards of our clients' capital, and we need to look at the case for investing. That's also very important for us as investors. So I'm just drawing you to a slide here, which is a very simple survey done of pension contributors. People in the UK contribute to their pension. Very simple. There are 2 points on this slide that I want to draw your attention to. First is the comment on the top right, which essentially contributors were asked if their pension, if they had a choice, right, of ESG and non-ESG investing, and they said if both return the same, 60% would favour the ethical option. So 60% of those surveyed of pension contributors would rather invest in an ethical option if they believed it returned the same. Now, we're not talking about beating here. We're just talking about the same. Okay? And what you probably know this, and all of you have heard this, I'm trying to debunk this myth that investing in the ESG market doesn't generate you the same returns, right? That's a huge myth that, we as TAM, I've spent years trying to fight. So I just want to talk about it a little bit here. The second point is on the bottom left, which is 46% would be more likely to pick a fund that only invests in SRI, returning 6 rather than 6.5. That's people say, that's nearly half of those surveyed said they would vote for the ethical option despite the fact that it generated them a loss. That just shows how important it's becoming to people. These are pension contributors. So I want to move on here, right, to talk about the investments, right? Let's just have a look at that for a second, okay? What I put there is since 2017, MSCI World. Fine, that's the global benchmark, okay. So you've had 2017, not a great year. 17 was a good year, 18 was not a great year, 19 was a good year. Okay, so, we've seen them all there, right? MSCI World. What have I got here? That's the red line, Terry Smith. Arguably, Hall of Fame, global manager, every single person owns him. If you tell anyone that you have your pension or your ISA or your SIP invest in Terry Smith, pat on the back. There's nobody that's going to dispute that. Great manager. Now, he's arguably, he's a mainstream, he's a non-ethical, right? Let's have a look at owning an ethical fund. Right, that's Bailey Gifford Positive Change, okay? A very solid ethical fund, right? Investing for a better tomorrow. Look at that return over 3 years. And just remember that 60% of those surveyed would go for an ethical option if they believed it returned the same. Well, look at that. Over 3 years. That's beaten one of the best managers in the mainstream space, in the Hall of Fame, and you've got ethical doing that. That's a very powerful slide for me. So, fine, we're now in a bear market, first in 11 years. Let's see how we've done on the way down. We can see MSCI World there, going all the way down. Now, majority of investors invested in global stocks would be participating in that. And you can see up top here, Fundsmith and the Ethical Fund, protecting capital on the way down, outperforming the wider market. And even the Bailey Gifford Fund, by a hair, has outperformed on the way down. So look at that, 3 years of investing over 3 different markets, positive, outperforming one of the best managers in the world. On the way down, outperforming one of the best managers in the world. So let's have a look. We've seen a 20% rally back from the low. Again, outperforming on the way back up. So what you've got here is you've got a fund. And I'm using this fund as a broad brush for the ethical market, right? Because Bailey Gifford is a good fund. It's not it is one of the best funds, but this is not the only manager doing this. ESG managers are not some special subset of managers that know how to pick stocks better than mainstream investors. It's just that the fundamentals of what makes a company attractive are becoming more and more skewed to ESG factors. Companies that operate in a sustainable way, an environmental way, with better corporate governance, they have better supply chains, they have better management, they have a more diverse board. All of these things are making these companies more attractive to mainstream investors, and you can see that in the performance. Not only is it more attractive on the way up, it defends capital on the way down. Just go back to that 60% of investors would go for the ethical option if it returned the same. And it smashes that. So what I want you to do is imagine for a second with me, just run with me for a bit on this one, okay? Imagine for a second, we're going back to this, right? If both return the same, 60% would favour the ethical option. Now I'm going to use the word extrapolate here, so just bear with me. If you take that sample and extrapolate it to the wider equity market, okay, so that's the whole investment universe. Imagine if the investment universe held the same sentiment as that 60%. You would start to see people shifting from mainstream funds like Fundsmith into funds like Baillie Gifford because of that drive, because of that performance. And that's aside from all of the things that I've listed out about why ESG is going to become mainstream. It's going to become the biggest disruptor in our lifetime. On an investment perspective, it makes the case so convincingly to switch. You could see pension investors switching from one pension fund to the other. That's trillions of dollars in pent-up demand for ESG products at a time when companies have never found it more important to become more ESG minded. Those two together, we think, is going to supercharge the ESG industry, and it's going to turn it into the mainstream industry. Again, biggest disruptor in our lifetime, not only for investors, but for companies themselves and the global planet. Nothing has taught us that like COVID has. So, final word, Warren Buffett. We seem to be having a theme with old Warren at the moment. Someone's sitting in the shade today because somebody planted a tree a long time ago, right? Again, just says it all from Warren. These ESG investors, ESG's been running for a very, very long time. This has been taken seriously for a huge amount of time. And we believe now that ESG is in the right space to be sitting under that tree because it was started such a long time ago. COVID has just served to really, really push that forward. I hope that outlines the case. For us, it does. I'm sorry if it came across a little passionate. For us, it's a real inflection moment, and we just wanted to try and get that story over to you guys. Over to Joe now for some questions.
Fantastic. Thank you very much, James. We've had a few questions come in. I'm trying my best to mediate them and just give them over to you to answer as many as we possibly can in one hit. Got quite a few on performance, obviously, so if we can start with that would be great.
Sorry, Joe, you cut out there. Could you repeat that one for me?
Apologies, we've got quite a few questions on the performance of our ethical portfolios. So if we could go through that to begin with, that would be great. Any other questions, feel free to keep sending them over, guys, as well.
Absolutely. Needless to say, as we saw on the Baillie Gifford slide of the performance, our ethical portfolios have performed very well in this downturn. They've protected capital. The investment team here made some strategic cuts to the equity position because whilst it is a high quality asset class ESG, it is not immune from the sell-off. All the funds collectively have outperformed. All the funds have defended capital well. So what we're doing is we're showing greater capital protection on the way down from our ethical portfolios, which you can see here. We've listed out the defensive benchmark in grey. The blue is the normal mainstream premier, and the green is the ethical, and those are the performance numbers that we're seeing in the ethical space. As you can see, the ethical portfolios are retaining; they are defending capital better. So again, it's outperformance on the way up, but it's also capital protection, it's capital preservation on the way down. Now that's by and large down to TAM's defensive approach. TAM takes a very, very defensive attitude to risk. It takes a very, very prudent attitude to allocating capital. We don't swing the bat. We make sure that every single investment is tested and double tested and risk monitored. So we like to make sure that in downturns we're always protecting capital. Now across the board we've been protecting capital in both mainstream and ethical, but the ethical portfolios, much like you saw with the slide against Fundsmith, have been doing the same, but across a much more diversified portfolio of funds. So we think we've done very well there. We're very happy with that performance. I'll just go back to that slide.
Brilliant. We have another question here. Are you still anticipating a further drop in markets linked to earnings reporting, or is that factored in already?
That's a great question. That's on the list of almost every single economist that I talk to. There's somewhat of a polarized view. Some economists believe that the market is so ready for bad news that there's almost nothing that's going to derail it. You know, you could look at French manufacturing numbers, French consumer numbers coming out of companies, massive losses, market rallied 1%. So, you know, there's a school of thinking that, yes, there are to be earnings downgrades, but it doesn't matter because the whole world, the stock market is essentially shutting its eyes and imagining a better environment and waiting for that. I'm personally in the second school of thought, which is that the earnings per share of a lot of companies in the US is barely been touched. It's barely been downgraded from its February high. Whilst I don't pretend or portend to know that those companies are going to get downgraded, it does seem foolhardy to assume that a company's earnings are not going to take a hit, and that is what's currently valued in the stock market. I believe that the stock market has got very, very carried away in the last 3 or 4 weeks. It's been bid up on virus cures, it's been bid up on the amount of central bank intervention, and I think the hit to corporates, the hit to the economy is yet to be factored in. So I do believe that the market is going to go lower. I believe it probably will, it could retest the lows, which, let's remember, that's another 20% drop from here. So at the moment there's a hell of a lot of good news priced into the market, and I hope it continues. But I wouldn't be surprised if we retest the lows.
Thank you. Some interesting questions here. Keep them coming. Any that we don't manage to answer right now, we will be sending them out, the answers to your questions out to you individually, so no question goes unanswered here. Interesting one here. Is there a risk that some companies that would be engaging more with end up being pushed into the private equity space by price collapse?
Yes, that's very true. I think some companies that that do need help in transitioning onto a higher quality ESG platform, higher quality governance, are at risk here. What I would say is there's a lot of private equity firms that are ESG minded and are ESG focused, and I think getting those companies back on track and getting them back into the limelight, whether it's private equity, whether it's fund help, whether it's investor assistance, I think is critical. I don't think you can stop progress, and I don't think some of these smaller companies, if they do get help, they do survive. They are they're going to continue to rally. They're going to continue to go further in an ESG-minded fashion. I am worried about some of these smaller companies and the government assistance for them and their survival. Sadly, I don't have an answer for that, but I do hope that these companies and some of the private equity firms, the ESG-minded ones, will pick them up.
So we have quite a few questions on pricing in regards to ethical funds and ethical portfolios alike. There was a theme for a few years where you seem to be paying a premium to access these funds. Is that the case, and is that the case on the portfolio side as well?
I think there is an increased level of due diligence and research that goes into ESG companies, especially with funds, because funds need to make sure that what they're buying, what they're investing into, is truly ESG and not, just whitewashing, as some people call it. Companies that are, don't really have ESG policies, pretending to be ESG minded to attract that capital. I think that increased level of due diligence does warrant a higher fee. As with mainstream investing, those fees are coming down. They have to. There's too much pressure from the investment market not for them to come down. So historically, you have paid a premium. I believe that there will be an edge of premium over that. That premium will come down as more companies transition onto the ESG way of thinking. TAM makes sure that it leverages its reputation and its size in assets whenever it buys or initiates a position in a new fund, ESG or normal. We make sure that we always have the institutional share class. Often we get access to institutional share classes well below their minimums because of our reputation, because of our relationship with those fund houses. So yes, whilst the ESG cost of investing can sometimes be higher, TAM tries extremely hard to make sure in all cases it is buying the most cost-effective share class, well above its means. I hope that answers the question.
Certainly. We do have quite a few questions coming in here, guys. I don't think we'll have time to answer them all, but we'll try our best to get through them. A little bit of a tricky one here. Do you foresee a time when Amazon, Facebook, etc. pay taxes in the countries they raise their revenue at a fair and reasonable level?
I think let's go back to stakeholder interaction on this one. Let's go back to what the right moral thing to do is. It doesn't, for me, seem appropriate for a company that is multinational to pay its taxes in one nation. It should be each entity of that company, to my mind, and people might disagree with this, to my mind, each national entity of that company should be paying taxes in that region. That seems appropriate. It seems appropriate for the revenue that company is generating from that market to be giving back to that market in taxes to the government to help with spending, to help with infrastructure packages. It doesn't seem fair for them to try and get round in a loophole so that they can pay tax in one area. I would say that's the ethical view. I would say that is very much an ESG-minded approach. So let's assume that they are a company that aren't the best ESG company. I think in the future there'll be more pressure on them to behave more ESG-minded. So you'll start to see companies maybe ratcheting back on that we want to pay tax in one location line, and maybe going for more of a universal transparent tax agreement which is multinational.
Okay. Next question here. I think we'll do one more question after this one, and then examples of hedge fund management ruining balance sheet and causing debt leverage, which can be shown to not to be ESG and therefore cause good regulation going forward.
Yes, good question. I think there's a lot of bad behaviour on both sides, on companies and hedge funds and investors. There's a lot of bad behaviour, and going back to the stakeholder versus shareholder interaction, there's a huge amount of funds, hedge funds, investment vehicles set up by people that are hyper-focused on that shareholder interaction, that massive dividend back, doesn't need to be ESG, just make sure we max out the dividend. I do think those companies still exist and those investment vehicles still exist, and they will continue to not be a force for bad, but I think they will continue to try and pressurise companies to focus on the old ways. That's not to say that that's a bad thing, but I think you're going to see that even harder and harder and harder for those companies to push, for those investment vehicles and hedge funds to push those companies to behave in a more dividend-friendly manner than an ESG or stakeholder manner. So I would expect that entity, that subset, cohort of hedge funds that do promote that behaviour to maybe start to see some headwinds. I do think it's going to come under political pressure as well, a massive amount of political pressure. Going back to this populism argument, there's going to be a huge amount of pressure from outside the government, and we've seen populism pressure forcing the government to make decisions. I mean, you've got you've arguably got the Conservatives that were taking a very, very Labour stance to spending on the back of populism, Boris becoming more of a populist leader off the back of populism. So I think populism will force these companies to come to the table on ESG, and it will force out these hedge funds that want them to focus on dividends and shareholder interaction. It's going to make it even harder for them. So I think that's going to dissipate.
Brilliant. And the last question is going to be a bit of a tricky one, so apologies, James. It's quite far-reaching. How do we get the government to promote ESG impact investing post-COVID-19?
Wow. Okay. My first initial response would be more an emotional one. It would be to say, all of us have probably seen those pictures of China, the pollution levels in China. The fact that people in India can now see the Himalayas for the first time in 30 years. They're massive. I think they just go to show how much damage we do to this world. And I think governments just have to sit up and take note of that. I think mental health has become such a key factor in monitoring the well-being of our nation. I think there are some outcomes from COVID that are so big, and they cause such massive questions for governments, that governments just need to stop and take stock of what they're doing and put more money behind these entities. And I think all of them are ESG focused. All of them are pandemic related, pollution related, finding cures, electric vehicles. After the fact that you've seen what's happened to the Chinese pollution down 70%, there's never been more of a time to say, look guys, let's keep this going. Let's keep electric cars going. Let's ramp them up, because we want to keep this globe. We've had a rare opportunity to see what we should be doing. Mother Nature has shown us that. So I think governments are really going to pick up on this. Corporates, fund managers will all be driving for it, from an investment perspective, from a responsibility perspective, from the corporates and from the government as well, especially populism forcing in that direction. I think it's going to be big.
Brilliant. James, thank you very much for answering this question. Again, guys, I think that we'll leave it there in terms of the Q&A, just in the interest of time. We will get back to everybody that has asked the question, though, I guarantee that, on email. And if you would, of course, like to discuss over the phone, we'd be more than happy to do that. Please leave us any feedback that you care to give. We really do appreciate that as well, and they help us to build our further webinars. You can, again, download a copy of today's slides from the attachment section underneath the presentation, so please feel free to do that. But apart from that, I'd just like to thank you, James, for taking the time to do this presentation, and to thank the rest of the audience for participating and listening to us today. Many thanks.
Thanks, guys. Be safe.